Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I want to do things a little differently today in this video. I want to talk about some investing principles and kind of that relate to me and actually represent kind of a pet peeve of mine, if you will. In the investment industry, there's always a lot of discussion and even debates about, which is a better way to invest, value or growth. And we often try to categorize stocks as value stocks or growth stocks. And, one of the things that I think are very, very important here, and what I really want to try to accomplish with this video, is the idea that value and growth are actually joined at the hip. And in the words of a famous Frank Sinatra song years ago, you can't have one without the other. Well, just as Mr. Sinatra taught us about love and marriage, I want to try to attempt to teach you about value and growth. Just like you can't have one without the other in terms of love and marriage, as Mr. Sinatra taught us with his great song, you can't have both when you're looking at investing. Okay, in other words, you can't separate them when you're dealing with investing. And I want to try to develop that for you with today's video. I'm going to do some examples here, and I'm going to talk about how important growth is to value. Okay, and you can invest in a stock at a really sound value, and it doesn't necessarily mean you're going to make a lot of money. You can also invest in another stock at a great value and make a great deal of money, because the missing part of this whole discussion is growth. It's a combination of value plus growth, which is going to determine the rate of return that you ultimately achieve. Now, you can also add another factor in that. You can look at income. So it's a function of value, growth, and income is going to determine not just the total return that you're going to receive, but how you're going to receive that return. So let's go ahead and turn to FastGraphs, the fundamentals analyzer software tool, and let's evaluate some of the opportunities you get for value and growth and point out to you that value and growth are joined at the hip. Just like Mr. Sinatra said in Love and Marriage, you can't have one without the other. In other words, you can't think about valuation unless you're simultaneously recognizing the growth prospects that you're looking at that level of valuation, and vice versa. You can't talk about great growth without simultaneously focusing on whether you're getting good valuation or not. And I'm going to give you some examples of that here. Let's start with the low growth company, Campbell Soup. Okay, and what I want you to note on this graph is that Campbell Soup has grown earnings at 3.37%. That's about half the average company and about half the rate that the average company grows at. Okay, now if I look at this graph here and figure out what this company is offering me, the first thing that should come clearly to mind is I'm not getting a lot of capital appreciation. If I'd have bought this stock back in October of 2003 when it was trading at its normal valuation and held it during this time frame all the way through June of 2021, my annualized rate of return was about 3.8%. That's very consistent to the growth rate. That's just capital appreciation. Now, I added dividends and I got 5.8% total return, because total return is a function of capital appreciation, which is the price going from point A to point B, plus the amount of dividend income. Dividends are paid out of earnings, and that's this area down here at the bottom of the graph. This white line is a plotting of dividends. The point is that you can focus on Campbell Soup as a value investment, but it's primarily a value investment capable of producing income, but not capable of generating a high total rate of return, because the company basically is an income stock. The current dividend yield is 3.59%. The PE is 14.13. That gives me my valuation ratio of 6.5 to 7%. It's 7.8% earnings yield, which is attractive, but I'm only going to be able to earn on this stock what the stock, is capable of delivering to me from a standpoint of growth. So I can buy it at value, but I'm also going to get growth. Now let's examine performance here over this time frame that I've been showing you here. And let's look at investing a $10,000 investment on July of 2003 and holding it through November of 2021. And what, again, you're going to note that the capital appreciation was 2.98%, which is very consistent with what the growth rate was here with a little bit of valuation. It was slightly undervalued today. It was slightly overvalued at the beginning. So that's my 3.37% discounted a little bit because the stock is currently undervalued. So I'm right at that 3% level. Now I add in dividend income. I want you to note that I got more dividend income if I'd have made this investment back in July of '03, owning Campbell Soup, than I would have got from investing in the stock market, but I got significantly less capital appreciation. Okay, now I also want to point out that the S&P 500 currently is extremely overvalued, as I've showed in many videos in the past, and Campbell Soup is undervalued. But the real message here, the main principle I want to get across, is that value and growth are joined at the hip. You can invest in a low growth, high yielding stock like Campbell Soup, but you can't have expectations of making a great deal of capital appreciation on the stock, because it's simply not going to give it to you. Now let's contrast that with a faster growing company like Apple, okay, one of my favorite stocks on the planet, which I do believe is overpriced today. But I do want to show you some things about Apple here. I'm going to use my scroll bar here, and I'm going to go back in time a little bit. And what I want to look at is a time when Apple was growing its business at a very attractive rate, okay? And I could buy the stock when it was reasonably valued in the beginning. Here had a PE of 17.6, a growth rate of 28.97. Now, with growth stocks like this, when they're growing over 15% a year, I like to use Peter Lynch's formula, the PE ratio equal to the growth rate, okay? I want to see the company's price and valuation be consistent with the company's growth rate. So I've changed the time frame on you a little bit. I'm going from the end of 2007 out through, in this case, the end of 2020, and I've got about a 27% growth rate, and I'm measuring the PE ratio of 27.3, which is right where it is here. And I'm going back here, and I'm trying to find a similar PE ratio in the beginning. So that's close enough right there. So if I'd have bought it on February 15th of '08, paid a 26 PE, that's just, we'll call that close to the growth rate. The growth rate was 27.43, and then I held it to where the PE ratio was equal to the growth rate, or 26.6. Again, minor adjustments here. I get capital appreciation of 27.4%. I bought this stock at value for the growth that the company achieved at this time frame. You know, in other words, I paid about a 27 PE for a 27% grower, and I got about a 27% rate of return. I also got some dividend income, but I turned $10,000 in this case into $208,983. That's including dividends. I turned $10,000 into $198,000 in capital appreciation alone. In other words, my capital appreciation was almost directly equal to the company's growth rate. Value and growth are joined at the hip. A growth stock has a valuation that makes sense, just like a low growth stock like Campbell Soup I showed you earlier has a valuation that makes sense. But just because you buy a low growth stock at value doesn't mean you're going to make a great deal of money. But on the other hand, if you buy a really fast growing stock like Apple at a sound valuation, you will make a lot of money. Okay, so that's, very, very critical, I believe, to understand that. And, the same, you can run this through some other examples. Like, for example, if you look at Verizon, okay, over a long period of time. And again, I'm going to adjust this a little bit so that I get some nice valuation. I'm trying to calibrate valuation here for you. So I've got a little bit of overvaluation here. I've got a growth rate of 4.72%, but if I buy it at a PE ratio of 15, which would be what the fair value reference line, the orange line on this graph, would be, and the normal PE is 15. So I've got basically the market value and the intrinsic value in line, and then I'm ending the period here with a PE of around 14. So I'm going to tell you, before looking at the number, I'm going to get a rate of return here on capital appreciation only that's slightly lower than the 4.72%. And the answer is I get 4%. Now, that's because I had a fair value here to just a tad bit of undervaluation. Again, you always have to adjust for valuation, but the point is that my capital appreciation was consistent with the growth that the business itself generated. What made this investment attractive, if you will, for certain investors would have been the income, the dividend income generated, almost twice as much dividend income as the market, gave me slightly less capital appreciation and a slightly lower total return. But this would have been an investment that I might have made if I was looking for current income and reasonable safety. This is a good quality company. We all know who Verizon is. But the point is, I would never invest in Verizon with the illusion that I was going to get rich. Would be investing in Verizon because I consider it to be a reasonably low volatile stock that has a nice income yield, pays out a very high percentage of its earnings in dividends. And I even get a little dividend growth. I get dividend growth that's about equal to the growth of the company. Value and growth are joined at the hip. There are two peas in the pod, just like love and marriage. Love and marriage go together like a horse and carriage. I can tell you, brother, that value and growth go together as well. You can't really have one without the other. But the point is, there is no such thing in this investor's mind as a value stock versus a growth stock. All stocks have some element of growth, even if it's negative, and all stocks have a valuation component where their valuation is going to be driven and controlled to a great deal by the amount of growth that the company has. And that's what I mean by the fact that, value and growth are joined at the hip. And another good example of that for a growth situation would be to take a look at a company like Amazon. But what I want to do with Amazon is I want to look at it from a standpoint of operating cash flows, okay? Where Amazon is known to not make a great deal of money, but the company has generated great operating cash flow historically. So when I'm looking at Amazon, I want to look at the company through the lens of operating cash flow. So I've changed the metric here, and I want you to see how clearly the stock price has tracked operating cash flow. Jeff Bezos talked about that right in one of his very first letters to shareholders. He wasn't going to make a lot of money, but he was going to generate a lot of cash. And you can see that cash flow is what has given the shareholders of Amazon value. Now here we're using price to cash flow equal to the multiple of cash flow. In other words, we're looking at price to operating cash flow equal to the growth rate. So we've got 27% operating cash flow growth. We've got 27% intrinsic value calculation, which is the orange line. So if I, go back here in time, back to December, let me hit it just perfectly for you. That's close enough. January of 2008, my price to operating cash flow is 27.37. And if I hold it out here to, approximately that 27.37, again, I'll get as close as I can there. I want you to notice that my annual rate of return without dividends, my capital appreciation, is approximately what the company's cash flow was. It's approximately, it's 28.2%, but it ties very closely or correlates very highly with the 27.37% here that the company achieved. Value and growth are joined at the hip. Okay, and you can't have one without the other if you're going to be a long-term investor. Now, the key to this is you want to be careful that you're not overpaying for a stock. The worst thing you can do is look at a very low growth stock like Campbell's Soup, and I'm going to look at it from a standpoint of operating earnings again. There are times when the market puts these outlandish valuations on the stock, but I want you to note that you end up getting very poor rates of return when you invest in a low growth company at a excessive valuation. You've got to buy the stock when it's reasonably valued, and then hold it to measure it again to. You always want to measure valuation to valuation. Like I always say, measuring performance without simultaneously measuring valuation is a job half done. Okay, value and growth are joined at the hip. Okay, and you can invest in the greatest company in the world and overpay for it and end up not making any money, even though the business does extremely well. And one of my favorite examples of that would be to look at Walmart. Walmart has a great, very consistent, we'll take the price off the graph here for a moment. Walmart had a great growth history, and I'm going to use my scroll bar again. I'm going to scroll back here to a time when Walmart really had some pretty attractive growth. We are looking at growth of 11% a year. Okay, this is from the beginning of 2001 up through 2013. Now I'm going to put the price on the graph, and what I discover is that where the fair value estimate was 15, where Walmart should have been a $21 stock, it was actually trading at a $50 stock. So even though I got 11% growth out of the company, if I look at performance of Walmart during this time, I got 1.75% capital appreciation. And even when I added in dividends, I only got 2.91%. So what I did here was I took a great company and I overpaid for it. And I literally made no money holding this stock all these years, even though the business itself, if I look at it just from the business, Walmart grew their dividend from 28 cents to $1.59 over this time frame. Their earnings grew from $1.49 to $5.02 over this time frame. They had a very consistent payout ratio and a very consistent operating history. The point being is, and I'll close with this, I could not have asked for better results from a company than what Walmart gave me. It gave me consistency, a continuous increasing dividend, reliability. The only problem was value and growth, earnings growth, were not joined at the hip. They were disconnected. You can't have one without the other. Measuring performance without simultaneously measuring valuation is a job half done. These are investing principles that really can't be ignored. Anytime you're investing in a stock, try to buy it at a good value. And then when you're trying to think about what your future returns are going to be, you want to make sure you've got value aligned with that growth. So you're buying the stock at a reasonable valuation that is consistent with what the company itself can give you and positions you so that you can participate fully in what the company can give you as an investment. Anyway, this has been Chuck Carnevale saying thanks for watching. As always, this was an investing principle video. I like to do these from time to time. I hope you got something out of it. I hope you enjoyed it. If you did, please ring the bell, give me a like, subscribe to the channel if you haven't already. And you might want to take a look at fast graphs. You can see how you can use this to really analyze stocks and analyze valuation and rates of return. It's a great tool, and I think you get a lot out of it. Thanks for watching.